You do not have to lose an account, and you must not lose a trading account. If you lose a trading account, unfortunately, that is very stupid. Okay, so I'm going to show you a very practical approach to making sure you never lose your account. Okay, now everyone's going to have an initial drawdown, and again, there's two approaches. The wrong approach is to just keep going as normal. Okay, to just keep doing things and expecting things to turn around. Okay, unfortunately, you still have to do things in a very, very purposeful way, in a smart way. Okay, the smart traders that adopt the smart approach, which I'm going to show you in a moment, will typically find a trough around 25%. They'll then ultimately begin to make as many good and bad decisions. Eventually, equity curve gets back to break even, and then they go exponential. Okay, and why do they go exponential? Well, because guess what? They stuck around, they put themselves in the market, they experienced the market, they developed skills through time, and the result is eventually they made less bad decisions and more good decisions. Okay, money is a byproduct of good decision making. That is as simple as it gets. You make good decisions on a daily basis, you avoid the bad decisions, and you will make money. Don't forget, and I really want to stress this, trading is 50-50. It's buy and sell. By definition, you could flip a coin, you should flip a coin, and ultimately you should break even in the long run, because it can only go up and it can only go down. Where the loss making comes in, where we kind of put the odds against us, is in the approach we're taking to trading. We come up with these complicated approaches to trading, and all of a sudden that 50-50 dynamic starts to move in the opposite direction. Okay, so we need to simplify things and keep it simple. Good decisions must outweigh the bad decisions. This chart is ultimately reflecting what most traders will follow. But what I find so unfortunate is that these same trading mentors, they just don't tell you how to safeguard against it. They do all the good work, which is say, look, this is what it's going to look like. This is what I experienced. But what they don't do is go that step further and say, however, let me show you how you can avoid all of this, do this in a much easier way, and safeguard yourself so that, guess what, ending of trading career is never even a possibility. They just don't have that framework. And that frustrates me, because traders just need framework. That's all it is. Now let me show you what that framework looks like. Okay, so how do you manage things after a significant drawdown? Now, this is my framework. Okay, what is a framework? It's simply an approach to follow that is proven to deliver measurable, favorable outcomes. In other words, these are the steps I'll follow when I have a drawdown. Okay, now obviously I've tried to adjust this slightly to make it sort of useful for you guys, but this is by and large the steps that I'll approach when I am going through a bad drawdown or I'm struggling in terms of trading. Okay, the first thing is we need to adopt a smart framework. Okay, and these 8 steps is a smart framework. You can adjust this however you want, and at the end you'll understand how you adjust this. Okay, but the key to this framework is ultimately, first and foremost, we must adopt a safeguarded trading protocol structure that prevents avoidable errors. In other words, in very simple English, day one of trading, you need to have something in place that will never allow you to lose more than 5% of your account. Okay, that is as simple as it gets. If you don't have something in place that prevents that from happening, you're kind of starting with both hands behind your back. Okay, equally, most traders on day one don't have something that tells them ultimately when they should be trading live. They simply just assume now is the right time to go live, or they have a run of profitable sim trades and suddenly they think they should go live. So they have no protocol in place that says go live. Okay, they have no edge. So many traders go live with capital and they haven't even got an identifiable edge. So many traders start trading live or start putting money in the markets and they've got insufficient education. In other words, they haven't given themselves a sufficient amount of time in the markets to justify them even going live. They haven't got something in place to prevent over and under risking. There are so many avoidable errors and pitfalls that you must ultimately, at the end of the day, avoid before you even begin this journey. You've got to make sure you avoid them. Why? Because if you don't put something in place on day one, you are going to go and have that big drawdown. Okay, and the result is once you have that 10-50% drawdown, the reality is you're going to follow the same curve that most people follow, okay, which is you'll end up chasing the markets, you'll want to get your money back, you'll lose confidence, eventually you lose 30-40% of the account, you're no longer objective, now you just want to make your money back, you try and have one big home run, the next thing, the account's gone. Okay, so step number 1, adopt a safeguard trading protocol structure that prevents avoidable errors. Step number 2, only put your capital live when the data tells you to do so. Now, step 1 and 2, at this point, I can tell you right now, 95% of traders fail at this point already, because 95% of traders do not adopt a safeguarding trading protocol. 95% of traders do not have something to tell them when they should go live. Okay, so 95% of traders are failing even before they've begun. That is why, okay, and it's not my opinion, that is why the statistics are what they are, because traders are starting at the wrong point. They're all starting on day 1. Hey, look, this guy on YouTube showed me a strategy. I spent a week looking at it. I, did a bit of back testing, and now I'm taking my $2,000 and I'm putting it in a live environment. They've skipped so many steps. They failed to recognize that experience is required to develop skill, and skill is the determinant that leads to an equity curve rising. Step number 3, okay, so if you've gotten past 1 and 2, in other words, maybe you've got in place some form of a journaling tool, okay, great start, you've got this journaling tool in place, very important, or you've got a risk tool in place, excellent, you've got step 1 covered. Step 2, maybe you're taking one of these, trader funding programs where you've got to pass a test to trade with live capital, okay, good, you're doing the right steps, you're following the right order of things. Step number 3 now is a protocol. What is the policy that you're going to put in place to prevent you from certain things happening? So what I like to do, I've got a threshold 25% account drawdown. Okay, what this means is, and I recommend this to all of you, in the first 3 years of your trading career, if your account ever hits a 25% drawdown of its initial starting capital, stop. Pause, it's time for reflection. Okay, if you hit 25% down, you're doing a couple of things wrong. You're making too many bad decisions. And if you don't stop at that point, you'll find yourself very quickly at 50% down. Okay, now you need to start what we call the rebuild process. In other words, you need to go and write out, it's an objective written exercise. How did I get here? What were the steps that got me to minus 25%? Was it a slow grind down where I lost 25 days in a row, 1%? Or was I kind of slowly going up, down, up, down, up, down? After 2 weeks with frustration, I lost 10%, 10%, 5%. How did you get to that point in the first place? Because the how ultimately tells you what you need to do next. Okay, which is you now need to move on from that point, learn from those lessons, and begin by setting a new objective. Okay, so when you get to this point of 25% down, step back, observe what's gone on. Now, you need to get back to 0. That's the only objective you must have when you suffer a drawdown, okay? And you need an analytic timeline. Now, I'm going to quickly show you an example. I'm actually going to bring the application up. So the example I'm going to use is, let's say, for example, we have a $10,000 account, okay? And in our $10,000 account, we've just lost $2,500. So our account balance right now is $7,500. Okay. Now, in order to have an objective approach to getting back to 0, we need to know holistically how long is this going to take us. Okay. In order to know how long it's going to take us, ultimately, we need to know what we make on average in terms of profit and loss. Okay. So we know that we need to make, roughly speaking, a 33% return to get back to our original capital. And let's say our typical average daily profit is $100. Okay. Now, with a simple tool, we've got something that's driven completely by data that says, look, it's going to take you 24 days to reach that target. Now, when we create these parameters, what we're suddenly doing is we're removing the sort of the chimp brain that says, look, you got to get this loss back as quick as possible, 1 week's hard work. No, we remove all of that. We take all the pressure off and we say, look, all you have to do is come in tomorrow, one good decision, one good trade, make your $100, do that for 24 days and get back to 0. Now, the reason most traders will not do this is because nobody wants to work hard for 24 days just to get a loss back. Everyone wants to make it back tomorrow. The reality is this game doesn't work like that. How it typically works, and take this from someone that's had a number of drawdowns, how it will typically work. You'll set this objective, it'll say 24 days, you'll follow it for the first week, and all of a sudden your confidence returns. Suddenly you have a $200 or a $300 day back, and you're like, hey, cool, I just skipped 2 days. That confidence flows over into the next session, and suddenly 24 days actually becomes 10 days. That's normally how this works, and that's why this smart approach works very well. Okay, now, at that point, very important, 2 steps that matter. You must, when you go through a drawdown, adjust your daily risk. Why? Think about it. When you've gone through a drawdown, you are very scared to trade. Okay, your psychology is a bit damaged. It's a bit fragile. So rather than trying to use the same stop every single day, come in and adjust that stop by 25%. Okay, so again, on a $10,000 account, maybe you've got a 5% stop. So if your usual stop is $500, adjust it by 25%. Okay, bring it down all the way to 375 odd, and make sure that you're adjusting that stop to safeguard you. Okay, that's the key. All it does is it takes a little bit of the pressure off. It means you're not losing as much as you usually do, and you're safeguarding ultimately your psychology from hijacking your decision making. Okay, the next step, set upside targets. Okay, now if you usually make $300 a day, for example, change that to $200. Make it easier for yourself. Why? Because when we go through a drawdown, the only thing we need to do is be green. Okay, we need to make it as easy as possible for ourselves to get our confidence back and to get our process back on track. Then, once you've made 1/3 of your loss back, okay, so we lost $2,500, our account's down to $7,500. Once we've made back, roughly speaking, $800, $850 odd dollars of that, put your daily stop back to where it was. Why? Because all we're doing now is we're taking profits and we're using those profits to ultimately risk on the upcoming trades. Okay, it's a very clever psychological trick that ultimately enables you to get back towards that break even a lot quicker. Then, when you get back to zero, this is the most important point. Stop. Go and develop your framework. Because guess what? You might not follow all these steps I've given you, but you'll follow some of them, but you'll also adopt your own unique steps. And it's those unique steps that you're going to apply in future iterations of drawdowns. Because guess what? You are going to have a number of different drawdowns in your trading career. Okay? So take that experience, learn from it. What did you do? What were the processes you adopted? What was the coping mechanisms you used? Did you trade only morning sessions? What is it that you do? Be very specific, because next time around, you want to be specific and adopt the same framework that worked. Okay? Finally, set a new objective. Okay? When you get back to zero, it's now time to spread your wings and fly. Continue learning, continue developing the skills necessary.